Hi, I'm Naveen Gajdala. I work for Oracle in the product management team for Oracle Leasing and Finance Management as well as Oracle Property Manager. Today, in this session, I will be covering the sweeping changes introduced by IFRS 16 as well as the FAS ASC 842 around the leasing industry and leasing business. I'll also take you through the Oracle solution as it happened and what are changes that we have taken up for the property manager. The solution for Oracle Lease and Finance Management is still in progress and that is now not out as yet. Let me start sharing the screen. Both the accounting standards in the year 2016 converged, and now we have a lot more commonality as well as convergence between these two standards. And it took very long time for these two accounting boards to come together to agree upon very common things and then come out with almost a very similar kind of accounting standard for leasing in the area of property management as well as equipment leasing. For the International Accounting Standards Board, the new accounting standards has been labeled as IFRS 16. For FAS, it is being called as ASC 842, which supersedes ASC 840, which was in prevalence earlier to this. The accounting standard makes sweeping changes for the lessee accounting, both the accounting standards for that matter. As far as the lesser accounting is concerned, majorly the lesser accounting has not changed. The focus of this particular session is more to do with the lessee accounting. I'll be majorly covering these topics under the lessee accounting changes. There has been some tinkering around the way the leases are being classified from lessee's perspective. The IFRS 16 does not even have any specific rules for lessee classification of leases, whereas the FAS has very clearly mandated the rules which need to be evaluated for a lease to be classified into finance lease or operating leases. Most of the existing rules around the fair market value of lease being compared with the present value of rents and the purchase option being present, transfer of property in a lease remain as is. So majorly the classification rules do not change. However, the FAS is very categorical in saying what needs to be classified as the finance lease and operating lease. Apart from that, some of the rules have been very generic. When I say generic, for example, they have been using the words substantial. Now, what is substantial needs to be decided from case to case, and a uniform yardstick cannot be applied for classification of leases. As far as the lessee accounting is concerned, the initial recognition and measurement is as below. Both for finance lease as well as operating leases, there is going to be a big change on the balance sheets of the lessees. Earlier, as for at least the IFRS, most of the leases were not on the balance sheets of the lessees, but the finance lease for FAS were already on the balance sheets. Now, what additionally gets added here, the operating leases as well as the finance leases for the lessees will be on the balance sheet of the lessees. And how do we bring these onto the balance sheets of the lessees? We create a lease liability on the liability side and also an equivalent amount for ROU. I say equivalent amount. For most of the cases, it is an equivalent amount to the lease liability. In some cases, however, the accounting standards have given some leeway wherein if you want to tinker or if you want your ROU to be changed, it can be changed. Now, what is ROU? ROU is the right to use a particular asset. So now going forward, we will be assigning a value to the right of use, and that value will be assetized. It will be capitalized in your books if you are a lessee and will be shown in the balance sheet as an asset. Now, what is lease liability? So lease liability is my future obligations, and I need to do a discounting of these future obligations, find the present values of the obligations in a particular lease. When I say obligations, the obligations can come from the options for terminations, residual, renewals, purchase options, as well as there could also be rent and some other major OPEX charges which you want to be recognized as a lease liability. We find the present value of this total, and that will form or constitute your lease liability. And for an equal amount, we also create a right of use. And now the right of use could differ from the lease liability if there are some initial direct costs or if there are any prepaid lease payments. These are added to the lease liability as arrived above. From that number, if you have any lease incentives which flow from the landlord to the tenant, I'll be going forward, I'll be using the word tenant more often. So after deducting the lease incentive, the amount that remains will form your initial ROU balance. And the accounting standard is also very clear when it comes to definition of the initial direct costs. Any costs which are avoidable had the lease not been authored will form your initial direct costs. And the accounting standard also tells the lessees to very carefully segregate between lease components and non-lease components. The reason why we need to doing this segregation, only the lease component payments will form part of your balance sheet amounts for lease liability as well as ROU. If there is a non-lease component, something like a service charge, which need not be capitalized, which need not be accounted as an asset, can be expensed off as and when it arises, and need not be capitalized and need not be tracked like an ROU asset. And one more very important aspect of this entire accounting is the subsequent recognition and measurement. Having initially recognized the lease liability and ROU, the accounting standard also tells the user to maintain these balances over the life of the lease. When I say maintain the balances, the lease liability has to be amortized just like any other loan. Whenever there is a payment for the lease liability, that needs to be deducted from the lease liability, and the interest expense, the period of time for which the lease liability is outstanding. For example, if the periodicity is a monthly periodicity, then after deducting the initial payment for that month, the payment can be for rents, it can be for some heavy OPEX. After these amounts are deducted on the remaining balance, the accounting standard tells us to use a discounting rate and find out the interest expense. And this is how the lease liability needs to be brought to zero by the time the end of the liability. And also for the ROU has to be maintained and amortized over the life of the lease on a straight line basis. With this background, I'll quickly take you through the high level presentation, which will give you more idea on what Oracle is trying to achieve through its solution, as well as this will also give a very good idea on the background of the project, the accounting standard changes, and stuff like that. Let me get started. This is the agenda for all our presentation that we do to most of our customers. We tell them the project background. So as far as the project background is concerned, as initially quoted by me, the accounting standards have more or less been converged. Now both these accounting standards talk the same language. They want the lessees, the tenants, to capitalize these leases on their balance sheets. And there is a very important aspect of this accounting standards. For the FAS, the effective date for majority of the customers or majority of the entities will be December 2018, whereas for IFRS, for most of the customers, the effective date of these accounting standards coming into picture will be from January 2019. Having said that, the accounting standard also gives the tenants two ways of adopting this particular accounting standard. We also call it as transition methods. So there is a modified retrospective method, and there is also full retrospective method. If somebody is following full retrospective method, then there is a 2-year look back period. What do I mean by look back period? So the accounting standards tells the users to implement these accounting standards as of January 2017 and keep maintaining these balances. So when they report their financials, they need to complement their reports or the financial statements with 2-year look back uh, accounting reports. So these reports are being called as comparative balance sheets and comparative income statements. So the customers who take the full retrospective method, they are also needed to report for 2 years, and this period is being called as look back period. If somebody is following the FAS, the look back period is 2 years, and if somebody is following the IFRS, the look back period is only 1 year. So to protect the interest of our customers, to see that all our customers are compliant, what we have in the solution, the accounting standards can be uptaken from January 2017. If somebody wants to do that, there will be reports. These reports will report the balances and also the amortization schedules to the customers so that they can prepare their comparative balance sheets and income statements. That about the 2-year look back period. And the accounting standards has so many impacts for the tenants, as already mentioned by me. For the balance sheet, your lease assets are going up, your financial liabilities. Now, this is not a, again, talking of the lease asset, this is not a physical asset, it is a finance asset. Your asset is going up, your liability is also going up, and probably your equity, because the difference between your asset and the liability needs to be adjusted to the reserves. Your equity or the reserves may be going slightly down if these two numbers do not agree. Coming to the income statements, your operating expenses are increasing, whereas your operating costs expenses are increasing. The reason being, earlier, the entire lease expense was being expensed off immediately into the income statement. But going forward, the lease expense has to be broken down into amortization expense as well as interest expense, and this may result in slightly lesser expenses initially, and over a period of time all the lease expense will even out and you would be charging the same amount to your income statements. So initially there will be a slight reduction in your operating expenses, but your finance costs are going to go up. So earlier, the interest expense was only being calculated for finance leases, but going forward, even for the operating leases, they are going to be subjected to the same treatment. You would be finding interest expense on your finance on your operating leases, and hence your finance costs are going to increase. For the cash flow statement, almost similar kind of impact here. Your operating cash flows are going to slightly take a beating, going to come down a bit. This is a good sign. But your financing cash flows are slightly going to increase because of this segregation between finance lease and operating lease not being there anymore. All your C-level managers need to know these balances, these amortization schedules. They need to know what is the impact of the financial statements. Your controller, your lease administrator manager, they all need to keep a finger on this. They need to be updated. What is the impact? How do they migrate? How do they adopt the new accounting standard? What are the transitional expedients or the transitional methods that have been prescribed in the accounting standard? They need to understand all of this. Moving forward. With this background of the project, let's see what is Oracle's approach, at least in property manager. So this particular project, to meet these requirements, the compliance requirements, has been broken down into 2 phases. We call it as phase 1 and phase 2. For phase 1, we only take up the 2-year look back period requirement. We will be providing the customers with all these balances and the amortization schedules for those 2 years. And we do not intend to make any changes to your financial statements, or there wouldn't be any accounting driven in your books. It's all going to be working on top of your financial statements or your financial books. We would be complementing with 3 major reports. I'll come to that. So as mentioned by me, for phase one, the focus is adding to the infrastructure. When I say infrastructure, we need to make some changes to the leases, the way their leases are being captured today. The cost of funds has to be captured because when we calculate the present values, the PVs, the cost of funds, which is the discounting rate, is what needs to be applied. I'll come to that a little later. And we will be providing you in phase one with all these look back period reports, plus all the infrastructure that is needed to generate these balances from the system. For the phase two, we will integrate these balances with the subledger accounting solution so that our customer should be able to account for these balances, create these balance sheet accounts in their financials using our phase two solution. So that is when the integration with the Oracle subledger as well as the general ledger will take place during phase two. So briefly talking about the differences that still remain between the IFRS and the US GAAP as far as the tenant accounting is concerned. On the landlord, as I said, mostly the impacts are very minimal. So that is why that is not the focus of this particular session. Moving on to the tenant side, the US GAAP still maintains two models between finance lease and operating leases, whereas the IFRS has almost like removed this separation line. So be it finance lease or be it operating lease, all the leases are going to be accounted similarly for IFRS purpose. The expense, the ROU expense, the amortization expense is going to be recognized on a straight line basis. In the income statement for the IFRS, there would be two lines. There would be two lines which will be posted. One would be the amortization expense. The other would be the interest expense. Whereas the US GAAP, a single line will be posted to your income statement, which will be the sum of your amortization expense as well as your interest expense. And how does, for FAS purpose, the interest expense is calculated? The interest expense will be calculated on the outstanding balance of your liability. When it comes to amortization expense, the calculation is slightly different. It is not a straight line basis. So there is a concept called lease expense. Now, what is lease expense? Lease expense is the total of all your cash outflows which you recognize as contributing to your expenditure on the lease. It can be the OPEX, it can be your rentals. All these amounts are summed up and they are evenly spread out throughout the life of the lease. For example, when you do this, your per month amount comes to $10,000. Then you deduct the interest expense, and whatever remains, that will form part of your amortization expense. So other way defining this is, for every payment that you make towards your lease expense, you're splitting that into your interest expense as well as your amortization expense. That is like a typical amortization of your loans or any financial liabilities. So the FAS follows that method of splitting, whereas the IFRS mandates that the ROU has to be recognized on a straight line basis. With this background, let's move ahead. So these are the impacts in the balance sheets, both for IFRS as well as the FAS. You would be creating a balance sheet asset, you would be creating a liability, and you would be accruing interest on your lease liability. You would be amortizing your ROU, and then you will finally recognize the sum of your interest and ROU expense, amortization expense, as your expense for that period. Let me move forward. And we intend to present all these balances in the form of report as being shown here. There would be two reports at portfolio level. When I say portfolio, it is a portfolio of leases, all the leases for a particular operating unit. That is what we call it as portfolio. So we would be providing a portfolio summary report, a portfolio detail report. When I say portfolio detail report, we would provide all these numbers for each of the lease in that portfolio separately. When I say portfolio summary, we would present these numbers for a period for all the leases in that particular operating unit. Apart from these two reports, we also have a very important report, which we call it as lease detail report. All that coming up very soon. Let me move forward. So these are the changes that we had to do in the application so that these balances are generated, they are reported, and they are maintained going forward. We had to make a new entity called interest index. Now, as per both the accounting standards, for sake of simplicity, the tenant's borrowing rate can be used for all your discounting purposes. So what we came up with, we would provide a matrix, an interest index matrix, wherein the user can define or specify their discounting rates into the matrix. So for every period, there would be a column to capture your interest index. And we expect our customers to group all your leases into, say, 10-year leases, 20-year leases, 30-year leases, and then keep creating as many interest indexes as they are your groups for that particular operating units. So if there are 5 such groups, you may need to create 5 such indexes. After having defined the interest index, this interest index will now be added or attached to your lease header. And that is how, when you start calculating your present values, the interest from the index, which is attached to the lease, will be picked up, and then your balances are generated. More that when we visit the application. So for now, the payment terms have also been changed. We have new checkboxes called ROU and liability. So we want our customers to provide, for example, which payment term will participate in the calculation of ROU, and which other payment term will participate in the calculation of lease liability, or both, or none. So based on these checkboxes, the user should be able to take the decisions. And on the lease detail, as I already explained, the interest index and the adder rate needs to be added. Now, what is an adder rate? Now, after deriving the interest from the index, there may be cases for a particular specific lease that may not be subjected to the general discounting rate. You may want to increase or decrease that particular interest rate, which is fetched from the interest index, say by 0.5 or 0.75, or reduce it by minus 0.5%. All that can be manipulated through the usage of adder rates. And we also enhanced our renewal options. At the outset, I already explained, your cash outflows can also include the option amounts. Though the option amounts are not determined, the accounting standard says if the user is very, very sure that a particular option is going to be exercised by the end of the lease or somewhere middle of the lease, then also take those option amounts into account for calculation of these balances. After doing that, we would come up with all the present value calculations, and then these numbers would be given to the user in the form of some reports. This is the flow at a high level. And as I already explained at the outset, not only these balances are calculated initially, these balances are also need to be maintained over the life of the lease. So during the life of the lease, they could be renewals, they could be some amendments. You could be adding some additional payment terms, or you could be contracting, terminating some of the payment terms, or you could be also terminating the lease altogether. So all these changes for the leases, they could be changes to the option amounts. All these changes needs to be maintained and captured, and the effect of these changes on the calculations for the coming periods needs to be accounted, or needs to be included into this report. That is what we are doing here. We quantify these changes, and we also report these changes. How do we do that? So these are the 3 reports that I was talking about. The lease detail report works at a lease level. It is very detailed. We would provide you with all the amortization schedules and we will explain you how did we arrive at these numbers. That's a very detailed report. The other two reports are at the portfolio level, at the operating unit level, and they give you some very high level summarized numbers. I will be showing you these reports as well very soon. And I was talking about the differences. It's very important that we also account for these differences. So, for example, when I start the lease in January 2018, maybe I started with a 1 million and for liability and ROU, and over and I start the amortization for this 1 million ROU as well as lease liability. So I would also come up with all the numbers for all the month ends, like what are the ROU and lease liability going to be for February 2018, for March 2018, for April 2018. But coming into February, maybe there is an amendment, and because of which my future balances are taking a hit. My future balances are being changed. When that does happen with your leases, so these reports will categorically tell the user, okay, for because of these changes, as that can be seen here, list of lease changes, there is a difference of say $50 for this particular month. So the February month originally started, the February month end balance should have been 924, but now it is 974. There is a difference of $50, which you could be accounting as increase in your liability or as a ROU. And this amount which is contributing to this $50 is being captured in the form of list of leases, which is explained below. And to achieve this, what do? We archive all the leases. We archive the leases every month end. We also archive all these calculations. So once I have the archive data, say for the month of March 2017, and when there is an amendment or there is a change for the month of 2017, I will calculate with my archive data for that period. If there is any change, this amount is reported as a change, and we will also provide you the list of changes which account for these changes. And the archival of data has twin objectives. One of the objectives being reporting of these differences. The other objective being we also maintain a very good audit trail of all your data. So you could keep taking archival. There is an archival patch. Use the archival patch to take the archive of data for each of these month ends. So at any point in time, whenever you go back to March 2017 and you make the calculations will be for the amounts as they existed for the month of March 2017. So the data integrity, the data sanctity is not lost. It is maintained and archived in the form of an archival of data. And anytime you run the calculation, you would get the same results. So this is what I was talking about. So these are high-level timelines. So the 12.13 as well as 12.24 plus, I would say 12.2, the patches, the final solution for general availability have been released in the month of October 2017. You can download these patches, try them out in your test instances, and can come back to us with your questions. I will also come back to the presentation after I perform a quick tour of the application. Let's take a quick tour of the application so that we understand all these concepts and we start relating, and we also start understanding what is the Oracle solution for these requirements. Okay, let me take you to the application. I will log into Property Manager. I will be demoing primarily 12.13 code. Okay, this is the Property Manager responsibility. That has a big list of workbenches. To start with, I'll start with the setups, and primarily around discount rate index. See, both the accounting standards, for sake of simplicity and practicality, ask the users to use the borrowing rates if that is readily available, which is always readily available. The other rate which the users can include or use is the implicit interest rate in the deal. Again, this IAR is slightly difficult to get. So for sake of simplicity, let's all use the borrowing rates. And this is the way the index is defined for operating units. The indexes work at operating units level. So for example, let me create one for Vision China. I'll provide my name to this. Navem index 10. Effective date, I'll start with Jan 2000. And why do we need 2000? It's a very interesting question. Though the balances are generated or reported from Jan 2017 at the latest, you cannot go beyond Jan 2017. But for the sake of calculations, we look at the lease data from the inception. So the inception could be in 2000 or the inception could be in 1990, whatever. If there is a lease which is like 40 years old, we look at all the data that is there on the lease. There is an option for the user to either start looking at the payments after January 2017 or look at the payment data on the lease from the time of inception. If the inception is 1990, we look at the payment structure from 1990 and we build these balances. But the reporting will only happen from January 2017. Okay, now my start date of the first period will be 1st of January 2000. Let's say my interest rate is 5% at that point in time. Then I may want to add one more row. I may want to add one more row, say for 10% or 15%, if in January 2017 or 18, the interest rates have changed. Why do we need to capture all these rates? Because when a new lease comes into picture, when a new lease starts in 2018 or 2017, we will pick up the interest rates from this index and as we attach that to the lease. So let me take you to, say, for example, one of the index which I would have already created. I just created a simple index for one of my customers and my interest rate is 7.5%. But I can also append more rates if the interest rates are changing. So every lease, based on its start date, the commencement date, the relevant interest rate will be picked up. The standards are also very, very specific over the life of the lease for certain events, like a purchase option change or a termination change or there is a renewal. In all those cases, whenever that amendment takes place, the interest rate as on that date needs to be picked up and uniformly used for the remaining life of the lease. When we do that, there would be changes in balances due to the change in interest rates being futuristically applied. So we also report any change because of the change in interest rates. More on it when we take a detailed tour. Okay, after having defined your discounting rate, let's cross over to the application. Let's move to the application and understand all the changes that have gone into the application. Okay. Let me pick up a lease which I would have already created. Okay, I will open a lease. I'm just trying my best to cover as much as possible in a 1 hour video, but I'm pretty sure this topic needs more than 1 hour. Okay, the application opened. I will query a lease which is already created for this purpose in the interest of time, and I'll open this in edit mode so that you can see the different components of this lease. This particular lease starts in 2016 and it has a termination date of 2017. The discount rate index which is attached to this lease is at Hutchison 7.5. This is 7.5. And what we additionally introduced is something called as accounting method. We want our users to classify the leases outside the system and then pick up the relevant classification like operating lease or finance lease, or there could also be some leases which you need to exclude them totally from being reported. For example, both these accounting standards, for sake of simplicity, they provide a practical expedient where you can any lease which are with a lease term of less than 12 months need not be reported. So you may choose excluded in that case. But there could also be some leases where you want a multi-gap. What is multi-gap? You may want the same lease to be reported both as finance lease as well as operating lease based on the local laws of the land. The same lease may be tracked by both the parent company as well as the local company, in which case you need something like that. Let's quickly, okay, my functional currency is CNY. All the balances, everything are always reported in the functional currency. And even if the payment terms are in a non-functional currency, they are converted into functional currency, and the entire lease is always reported in functional currency with all its balances. Coming to the payment terms, I have already defined 3 payment terms. One for operating expenses, which is a one-time. The other 2 are monthly frequency payment terms. Now, these checkboxes are very important. We all know what is normalization, so I'll not spend much time on this. The other checkboxes that we introduced as part of this enhancement are ROU asset, lease liability, report from inception. So using these checkboxes, the user will have to specifically tell the system which payment term needs to be included for calculation of ROU asset, lease liability, and which payment terms need to be reported from inception. I already explained about the concept and the concept around report from inception. So we will follow that. And using these checkboxes, we will mark these leases as eligible for calculation of RAU or liability or both. When both the checkboxes are checked, it will be included in the calculation of both. We not only show the balances, we also tell the users how these balances have been arrived at and what are the amortization schedules for these balances. So that is why these checkboxes become very, very important. Talking about the amounts, the first amount is for the first year for 10,000. Then there is an escalation of 10%. So this amount goes to 11,000 in the subsequent year. And the one-time charge is for 25,000. Moving to the options are going to play a very important role going forward. So that is why I have a renewal option. This starts in 2018, it goes up to 2019. And there is an enhancement here. We call it as escalation percent. So if you have the renewals for say 5 years or 10 years, you can use this escalation percent if there is an escalation in the lease options. So the options can be one time when it is for termination, for purchase option, or for the residual, or they can be recurring, like in this case, where it takes the form of a normal payment term, but it is being defined in the options tab because the option amount is not forming part of your payment terms. If you define your payment terms for option in the payments tab, then that will take a different form altogether. If you want these not to be reported as payment terms, but still to be included into your calculations, then you will have to define these options over here. And just like a payment term, the checkboxes remain as they are. And the currency, the amount. So for the second year, there will be an escalation of 5% as defined here, and this amount will go $7,500 plus 5%. With this structure, I will run the calculations. Now, what is the process flow? We have provided you a calculation program. The calculation program can be run in final mode or in draft mode. Before that, if you had archived, there is an archival patch. You can download the archival patch. You can take archival of the data as of every month end. If there is archived data already present, then the calculation program will run on the archived data. If there are no archived data in the system, then the calculations will run on the production data. Okay, now talking of the modes of the calculation program, we call this as calculate balances and lease liability. The user will have to provide the ledger name, Vision China, for that matter. For example, here, now this particular field as of date plays very, very important role here. So it tells the system these calculations and balances are to be calculated as of which month. So though this is date, the values which can be picked up from here are the month ends. Every month. So Jan, Feb, March 2017 or 2018. So this is how the calculations have to be performed. We expect the user to run these balances as of every month. There can be some changes in the form of amendments, edits, or some other changes on the lease. So the user is expected to perform these calculations every month end so that if there are any changes, even those changes are reported. If there are no changes, then the calculations are not performed for that period. We call them actually recalculations. The recalculations are not performed, and the amounts that exist for the current month as per previous calculations are fetched and shown to the user as they are, and that happens very quickly. So for example, in this case, let's say I want my reporting period to be January 2017, and my mode can be draft or final. When I run it in draft, I can rerun for this period any number of times. I may want to make some changes. When I look at the reports, the balances, the numbers may not be acceptable to me as a user. Then I go back and make some changes, either to the discount rate or I make changes to the lease itself in the form of some changes to addition of new payment terms, addition of some negative terms, or change of the commencement date or whatever. I may do that and then rerun in draft again to check if these changes have taken place, are acceptable to me. If you find everything is good, fine, you may want to finalize the calculations for this period. When you finalize the calculation for this period, you'll have to run the program in final mode. This is the other mode that I was talking about. When you run this program in final mode, what happens here? This particular period is finalized. You cannot run calculations for the same period once again. And then there will be also an auto archival of lease data and the calculations. They are archived for future reference as an audit trail, whenever you want to do. So after the calculation program, either it is run manually or it is a scheduled run, then you may want to run the reports that have been provided as part of this enhancement. Something like, let's run lease detail report. Very important report. This is the report which is at lease level. And currently, I am in November 2017. But because I have an archived data, I have the calculations archived, I can rerun the report for any period going back. So for example, let me take January 17 and run the report for that particular lease. We took a look at NAV demo. Let's take a look at that lease. I'll submit the request for this. Once the request is submitted, let's take a look at the output for the report. I fired the lease detail report. The report is complete. The report has a lot of information. So it tells me the lease number, the commencement date, end date, it's for 24 months, and the date convention which we use for the calculation is 365 days in a year. And very importantly, the representation is operating lease. So when I have operating lease, the US GAAP actually records these numbers or calculates these numbers slightly different from a finance lease. For IFRS, the calculation is no different. And my as of date is 31st January 2017. I have two sections in this particular report. I have the header summary section, wherein I calculate what are these numbers for each of the periods. Jan 2017, February 2017, March 2017. I calculate till the end of the lease, starting from January 2017. But the numbers that go into this calculation can start from lease commencement date or can start from January 2017 as per the choice of the customer, of the user. Okay. Now, I also report not only the liability balances, I also report what is the cash outflow for that period, what is my interest accrual on this liability for that period, my ROU asset and amortization expense. And I have a heading of finance lease here as as well as the IFRS operating lease, they account or calculate these numbers similarly. So that is why I have a heading of finance lease as per US GAAP and IFRS operating lease both follow the same methodology. So the ROU asset calculation and amortization expense is common under this heading. So it has been put here. But when it comes to operating lease for US GAAP, the ROU asset and the amortization expense will differ a little bit. So we have the interplay of lease expense. We deduct the interest expense. The interest expense calculation is similar in both the cases. The interest expense is deducted from the lease expense to arrive at the amortization expense. And these are the numbers till end of the lease. So here are the payment terms. I have my first payment term for 10,000. It starts in January 2016. This is for 12 months. My liability, ROU, and report from inception are all checked. In this case, my frequency is monthly, interest rate is 7.5%, and my lease liability is standing at this amount. This is as per the initial calculation. These amounts are calculated for the first period, month end. And how did we arrive at the ROU calculation as a lease liability calculation? Here are the calculations. I use a discounting rate of 7.5% for the number of days outstanding for each of these payments. I calculate the present values. I get the present value. The total of this present value is 115,991 is the total PV value for this payment term on 1st of January 2017. Okay. And then I also present you with all the amortization schedules. Okay. I started with the ROU balance of 115,991 and the amortization for that period is this much, and the ending balance comes to 111,665. Since our first reporting period is from January 2017, I'll pick up these numbers and start the reporting. But for calculation, I start from lease inception. But for reporting, my initial balances will be reported for these periods. And same is the case with lease liability. I have a beginning lease liability balance. There is a payment deduction in advance that is deducted. The interest expense is calculated on the outstanding liability balance. And this is how the ending balance, which is after deducting the payment from the opening balance and adding interest to it, we arrive at the ending balance. For US GAAP, we also need the lease expense. The lease expense for this payment term in this case happens to be 5,000, which is when it is spread over the lease life, the remaining lease life. So my amortization expense in this case will be 5,000 less the 675, which will be my amortization expense as per US GAAP. For IFRS, this is on straight line. Here is the IFRS. For IFRS, the amounts are on a straight line basis, but for the US GAAP, the logic is we deduct the interest expense from the lease expense, and whatever remains will form part of your amortization expense. So for those months, if you're following IFRS or if you're following the US GAAP, you could be picking up these amounts and then manually generating these transactions in your system. If you want to uptake the financial statement, the changed accounting standards from January 2017, or you could wait for a phase 2 solution when system will start accounting or generating this out of the system. So you could use these balances even for reporting purposes. As I said, there is a requirement wherein you have to report your compliance balances for comparative purposes for 2 years. If you're following full retrospective method for FAS purpose, and if you're following modified retrospective method, then the requirement is only to report for 1 year. Okay, now the same way the calculations are performed for every payment term. So if you look at the second payment term, there were no payments in the initial part of the lease. For the first year, no payments. The payments start from January 2017, and that too, there is an increase of 1,000 from 10,000, and that is what has been taken into consideration for calculation of the leases. We also have one-time direct expense, IDC. So this particular payment term only qualifies for ROU calculation. If you remember the checkbox, there is no lease liability because this was only one-time payment and it was paid away straight away. So there is no amortization for liability part. For the one-time ROU, however, the amortization stands like this. This is on a straight line basis for IFRS. Let's keep coming down to this one. We also have a renewal option here. So a renewal option is also treated like a payment term and it is included into the calculations. All these amounts from these payment terms are aggregated and reported in the form of this summary section on the report. So this ROU asset is the sum of all the ROU amounts for each of the payment terms. Similarly, for the liability, this is the sum of all the liability amounts from the payment term. This is about the first report. We also have the other reports, as I explained, something like portfolio detail report. I'll pull up one such report from the system. To make changes to your financials, you would be looking at portfolio level. So all the lease numbers, all the leases for that portfolio are printed here. There is a period beginning liability, there is a period closing liability, cash, interest accrual, beginning liability, closing liability for ROU, so on and so forth. Okay. So to achieve these balances and calculations, what are your action points as a customer? So there is preparatory work that needs to be done from your side. You will have to take the archivals of your data. You'll have to prepare your leases with all the checkboxes. You'll have to create the discounting rate indexes. And for updating existing leases, Oracle is also providing you with an update script, which can be used to update all your payment terms, leases with the discount rates, adder rates, and all the checkboxes for ROU, lease liability, and report from inception. So once you prepare your portfolio this way, you can start running the calculation program for each of the periods. So for example, you take the patch in November 2017, then you may want the balances for each of these periods, starting from Jan 2017, February 2017, if that is your reporting requirement, or you could choose to run them one shot on November 2017, and then you may choose to run these reports and balances every month end after that. And it is always a good practice to take the archival of your data so that if there are calculations which are not acceptable to you, or if there are any bugs in the product, you could raise those bugs with Oracle, and then meanwhile you can rerun these calculations once the bugs are fixed on the same archived data. The archived data is not changing. You would always get the state of affairs as of those particular months for which the archival is taken. I'll also show you there is a detailed release note for this compliance patch. You could go through that, and also you can come back to me. I am Naveen Gadidala. I work for Oracle. I'm in the product management team. And here are the patch numbers for both the releases. For the 12.1.3, the GA is through this patch. And for the 12.2.4, the GA is through this patch number. You could always come back to me with any questions that you may have at this email ID. Thank you. I hope this session is going to be useful to you. You can use this session to come to terms with the change in accounting standards, as well as the likely solution that you may uptake from Oracle. Thank you.